Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. In addition to those joining us in the boardroom, I want to note for the record that today's meeting is open to the public through a live webcast with closed captioning. Before we begin with our formal agenda today, I have several announcements. First, as some of you may know, Board Member Otska welcomed her newest addition to her family earlier this month. Both mother and baby are doing well. Although she is unable to attend today's board meeting, I thank both Board Member Otska and her team for their engagement and hard work on our 3 agenda items. Second, I would like to welcome the Credit Union Association of New Mexico, including the league's president and CEO, Malia Heimbuch, who are here in person joining us today. We always appreciate having stakeholders learn more about our work and to see the policymaking process in action. So welcome to all of you. Third, in the interest of transparency, I want to remind all stakeholders that both the 2024 fourth quarter credit union profile and the 2025 first quarter call report changes are currently out for comment. The proposed changes to the fourth quarter 2024 credit union profile were published on July 26th, and the comment period ends next week on September 24th. Additionally, the first quarter 2025 call report proposed changes were published on September 16th. These changes would provide for new fields related to loans granted to credit union officials and senior executive staff, liquidity arrangements, brokered accounts, non-member deposits, and uninsured shares, among other new fields. These changes also would eliminate fields related to the Paycheck Protection Program and credit impaired loans, as those fields are no longer needed. The comment period on these proposed call report changes ends on November 15th. As always, we welcome stakeholder input on all of these matters. That concludes my opening announcements. I now recognize Vice Chairman Hauptman for any thoughts that he might have on any of these matters or more.
Yes, thank you. We're obviously very pleased that Tanya and Zoe are both healthy and doing well. We look forward to having her back. Also welcome the New Mexico folks. I'm a sort of adopted son of New Mexico. I married into a family from there, from Albuquerque. My wife is a UNM Lobo. I put Hatch green chilies now in my eggs when I make scrambled eggs. Only place I've ever been, we're literally at McDonald's, at the kiosk. When you're making your order, it asks if you want green chilies. I assure you, if you go to one here, they do not do that. And the state director of the Financial Institutions Division, Mark Sadowski, I've actually never met him, and he was here last year, and I know his better half, Denise, quite well. She's a rock star. But of course, when Mark finally came here and was sitting in these chairs, it was the one time I had to do the meeting virtually because I was sitting in Albuquerque, New Mexico. So welcome folks from the land of enchantment. I'll mention for a state of 1.2 million people, I believe 50% are credit union members. That is, I don't know if it's the highest, but it's one of the highest in the country, and I hope your trip to DC is fruitful. Back to you, sir.
Thank you so much for those thoughts. The first item of business today is the board briefing on the Share Insurance Fund quarterly report. Our Chief Financial Officer, Eugene Sheed, is the sole presenter. Good morning, Eugene. It's good to see you as always. I also see that you got the purple tie memo today, so you are definitely on cue. Please begin whenever you are ready.
All right. Good morning, Chairman Harper and Vice Chairman Hauptman. I am pleased to present to you this morning the 2024 second quarter statistics of the Share Insurance Fund and an update on the NCUA budget. Slide 2. This table shows the fund's revenues and expenses for the second quarter of 2024. For the quarter that ended June 30th, the fund recorded net income of $86.2 million. A few highlights are as follows. Total income was $140.1 million for the quarter, mainly from investment income increased 5% compared to the prior quarter and increased 38% compared to the second quarter of 2023. Operating expenses were $60.4 million for the quarter, primarily due to the overhead transfer for agency operating expenses. And the provision for insurance loss reserve expenses decreased $6.1 million during the quarter. Slide 3. This table shows the fund's balance sheet as of June 30th compared to the prior quarter. As of June 30th, total assets were valued at $21.6 billion, of which 99% were funds held with U.S. Treasury and cash, overnight investments, and long-term Treasury notes. A few highlights to take away from this slide are that the fund's capitalization deposit receivable was fully collected in the second quarter. Accounts payable and other liabilities decreased mainly from the payment of capitalization deposit refunds of $238.8 million to credit unions whose insured shares had decreased. And the cumulative results of operation increased $142.7 million due to $86.2 million in net income and a reduction in unrealized losses on investments of $56.5 million. Slide 4. The fund records an insurance program liability comprised of both general and specific reserves. This is a contingency to cover anticipated future losses resulting from insured credit union failures. Each quarter, we assess the reserve needs for potential and actual credit union failures to make a reasonable estimate of potential future losses. During the second quarter, the reserve balance decreased by $5.5 million, primarily due to a decrease in the general reserves. The reserve balance totaled $212 million, and that is comprised of $10.1 million for specific reserves and $201.9 million for general reserves. Slide number 5. Through the second quarter of 2024, 2 credit union failures had occurred, which incurred a loss to the fund. Both were assisted mergers. The cost of the failures is estimated at $2.02 million. Fraud has not been identified as a contributing factor to either of those 2 failures. Slide 6. As of June 30th, 2024, the fund had over $22.5 billion at par value invested in Treasury securities with maturities out to November 2030. The weighted average life of the securities held by the fund is 2.3 years. The weighted average yield of the securities increased 11 basis points from last quarter, up to 2.54%. During the second quarter of 2024, 8 Treasury notes matured for a total of $750 million. These securities had yields ranging from 0.24% to 2.14%. These maturities were subsequently reinvested during the second quarter. Slide 7. The equity ratio. The equity ratio is updated on a semi-annual basis. As of June 30th, 2024, the equity ratio was 1.28% and was calculated using an insured share base of $1.76 trillion. The blue line across the chart represents the normal operating level. This was last set and approved by the board in December 2021, and that currently remains unchanged at 1.33%. Slide 8. This presents the projected equity ratio, the projection for December 31st, 2024, which is also 1.28%, unchanged from the June 30th actual. The stability is mainly due to the forecasted modest increase in insured shares during the second half of the year. The projected equity ratio is calculated on the same basis as the actual equity ratio, and that formula and calculation are shown on the slide. Slide 9. Moving to an overview of CAMEL's data, this slide shows the percentage of insured shares by CAMEL's codes from 2019 through the second quarter of 2024. In the graph, the dark blue at the top represents CAMEL's coded 4 and 5, the gray represents CAMEL's code 3, and the light blue represents CAMEL's code 1 and 2. During the quarter, the percentage of insured shares at credit unions, CAMEL's coded 3, 4, or 5, increased, while those at CAMEL's codes 1 and 2 decreased. The table at the bottom of the page shows the number of credit unions by the CAMEL's code. The total number of credit unions as of June 30th was 4,533, a decrease of 45 from the prior quarter. Slide 10. This slide compares credit unions' CAMEL's code by asset size. CAMEL's coded 4 and 5 credit unions are shown on the left-hand side of the graph, and CAMEL code 3 is shown on the right. Looking at the 136 credit unions, Camels Code 4 and 5, most of these credit unions continue to have assets of $100 million or less. For those with assets greater than $100 million, there were 10 credit unions in the $100 to $500 million range. For those with assets greater than $100 million, there were 10 credit unions in the $100 million to $500 million range. For those greater than $500 million, there were 6 more credit unions in 2024, June 2024, than in the prior quarter. During the quarter, assets and insured shares for credit unions, Camel Code 4 and 5, increased. Considering now the 743 credit unions, Camel Codes 3, 91% of these are credit unions that have less than $500 million. During the quarter, there was a decrease in credit unions with assets $500 million or less, and an increase in credit unions greater than $500 million for the Camel Code 3. During the quarter, assets and insured shares in credit unions, Camels Code 3, increased. Slide 11. I will now transition to a brief overview of the NCUA's budget status for 2024. Slide 12. Through July, the operating fund budget has used 60.8% of its funding that was made available by the board for 2024, a rate that's generally consistent with expectations and prior years. Employee pay and benefits is tracking very close to expectations as the agency has maintained a low vacancy rate. Travel spending has increased compared to recent years, and we project most of the available travel funds will be used by the end of the year. Compared to recent years, we forecast a smaller year-end availability of funds, currently projected to be about $5 million, or 1.3%. This would be smaller than what we've seen in recent years, which means there would be less surplus funds to potentially apply as an offset to the 2025 budget, as the board has done in recent years. Slide 13. The board approved a capital budget for 2024, which is $7.4 million. Through July, approximately 50% of the funds have been used. Key line items in the capital budget include cybersecurity, information technology infrastructure, and process improvements. As noted on the slide, a small reallocation of funds was made to increase funding for personal security case management system. Otherwise, all the approved projects are executing within the amounts made available by the board. Slide 14. The Share Insurance Fund administrative budget funds certain insurance-related expenses of the agency. Through July, 76% of the board-approved budget has been used. The line item we are monitoring here is state examiner training. We reallocated $100,000 from administrative expenses to state examiner training line item because participation rates at NCUA and FFIEC training classes have been higher than anticipated. And slide 15. In closing, the Share Insurance Fund is performing well year to date. The board-approved budgets are executing within the expected parameters. Supplemental slides provided with this presentation have additional information to help interested parties better understand the operations of the Share Insurance Fund. Thank you for your time, and this concludes my presentation. I'd be happy to answer your questions.
Eugene, thank you for your update on the performance of the National Credit Union Share Insurance Fund in the second quarter of 2024, the overview of the fund's projected year-end equity ratio, and the status of the NCUA's budget at the mid-year. And thank you to you and your team and the Office of the Chief Economist for their continued solid work in preparing today's briefing materials. The Share Insurance Fund's performance in the second quarter of 2024 mirrors much of the industry's financial performance during the same period. The fund, like the credit union system, is doing well overall, but there are warning signs that we all must heed. First, let me start with the good news. Since the 2008 financial crisis and the Great Recession that followed, the U.S. has maintained an unprecedented low interest rate environment for nearly 15 years. This economic environment prevented the Share Insurance Fund's investment income from offsetting the growth in insured shares the industry experienced during that same time frame. That's why there was a continual decline in the equity ratio in the middle part of each year during the last decade until the closure of the temporary Corporate Credit Union Stabilization Fund in 2017. In recent years, we have experienced a large growth in insured shares, especially at the height of the pandemic, when large amounts of government stimulus funds flowed into the credit union system, gradually depressing the strength of the equity ratio, with the lowest ratio being reached at 1.22% in June 2020. But the current higher interest rate environment has improved the fund's earnings. In fact, investment income in the first 2 quarters of 2024 alone exceeded the investment income of the Share Insurance Fund earned in all of 2021. So things certainly have changed, and I think you would agree that that's very good news for the Share Insurance Fund. Once more, the fund's yield in 2021 was just 1.21%. The Share Insurance Fund portfolio right now is yielding 2.54%, more than double 2021's level. That income, along with slower growth in insured shares, helped to stabilize the Share Insurance Fund's equity ratio at 1.28%, 4 basis points higher than the initial projected ratio for June 30. So Eugene, while the Share Insurance Fund is overall experiencing its best performance in terms of investment income in nearly 15 years, should we expect that performance to continue?
Thank you for that question, Chairman Harper. So both in terms of income and the weighted average yield, the fund has seen its best performance since at least the Great Recession. The yield is now at 2.54% and has benefited from the higher interest rates, especially in the overnight holdings. We have seen the overnight rates begin to fall from where, as recently as 5.4% in early August down to now under 5%. As of yesterday, that represented a decrease of about $82,000 a day to the fund, or about $30 million a year. However, the laddered portfolio has maturities every quarter, and those maturity buckets have average yields of generally under 1.5% for the next couple of years. As we reinvest those maturities, we will help to offset lost earnings from a decrease in the overnight rates. The amount of the offset will be highly dependent on the overnight rates and where they go, as well as the rates that we get on the reinvestments in the longer end of the SIF portfolio ladder. These challenges, this is the challenge for the investment committee, is to reassess the fund's overnight holdings and potentially place more of the funds in the investment ladder, which would help lock in longer-term earnings.
So just help me out here to make sure that I understand what you're saying. Are you saying that, yes, the long-term investments are paying a lower yield now because of that we invested them at the time?
Right.
But if I remember correctly, we have $5.6 billion
Yes,
in overnights right now, and that we're going to be moving out on the ladder. Are you saying that as we ladder, we expect those rates to go up on the longer-term investments?
Yeah, so I think there's sort of two balances here that we have to think about. There's the overnights, and we have seen those start to come down, and
Right.
those presumably would continue to go down if the Fed continues to reduce interest rates. The maturities that we're seeing right now in the longer end of the portfolio, the longer securities that we've hold, those generally have rates under 1.5% overall. So the next couple of years, we'll see those lower rates mature off. If the 10-year, which would, the longer term rates continue to be somewhat higher, then that will kind of offset. So we'll kind of see movement at both ends of the spectrum. But how that plays out in net, I mean, obviously it will depend on what the rates look like.
Okay. Thank you, Eugene, for that clarification. My next question relates to the fund's balance sheet. If we could pull up slide 3. On slide 3, we see the overall assets of the Share Insurance Fund declined slightly between the first and second quarters. This contraction may cause confusion for some. Would you please explain this slight decline in the fund's total assets and net, why this slight decline in the fund's total assets and net position occurred, and are there any seasonal factors at play here?
Sure. So that's really a factor of the refund that we did for the capitalization deposits. So in short, the agency refunded more in capitalization deposit adjustments during quarter 2 than we collected because there was overall decrease somewhat in insured shares the latter half of 2023. I think what's important here, though, is that the fund's cumulative results of operation increased. And so that's important for the stability of the fund.
So maybe it wasn't a seasonality, but it was a one-time event, just as we've seen this change in the composition makeup of credit union balance sheets.
Well, there's certainly a seasonality to the share insurance fund, insured shares
Right.
that we see. And so there's a seasonality. I would say the kind of the more unique aspect is we don't typically see a contraction in insured
Right.
shares, and there was a bit of that in the latter half of the year.
Thank you for those clarifications. Your response helps stakeholders to better understand that this slight decrease in the share insurance fund's balance sheet isn't a trend, and that the fund's total assets in that position should improve over the remainder of the year based on current projections. It also reiterates the point that the share insurance fund remains overall in a healthy position. My next question concerns the fund's future income. The higher interest rate environment has improved the fund's earnings, and the much anticipated drop in the interest rates will decrease unrealized losses in the portfolio, further improving the fund's position. In fact, just yesterday, the Federal Open Market Committee lowered the federal funds rate by 50 basis points and signaled the potential for additional rate decreases should economic conditions weaken. How are we positioning the share insurance fund so it can remain healthy in a declining interest rate environment? And we talked a little bit about that earlier, but I want to dive down a little deeper.
Sure. So a key responsibility of the investment committee is to determine how to position the fund's portfolio within the policy set by the board. We generally approach this responsibility by considering safety, liquidity, and yield, and I think personally liquidity being the most significant factor for us to consider. We've increased the fund's liquidity position in the overnight, we've already discussed, up to $5.6 billion. And that was in response to the longer-term holding in a loss position. So we have a total of unrealized losses on the portfolio. And somewhat also the softening composite CAMELS ratings. We want to be able to respond to liquidity events without incurring a cost to the fund or to borrow, which also comes at a cost. The declining interest rate environment should lower the loss position. So our unrealized losses should come down as interest rates come down. And that will give us greater liquidity options going forward should we need to access them. Up to this point, the yield has favored the overnights. So the fund has been able to maintain that liquidity without paying a premium, which we normally see in a more normal rate environment. And that concludes my response.
Thank you for that detailed response. Laddering investments in both up and down interest rate environments is a proven method, a proven way to smooth out interest rate fluctuations and maximize long-term performance. I know that's something that both the Vice Chairman and I learned as undergraduates. It's important that the Share Insurance Fund is healthy and able to respond quickly to any stress in the credit union system, regardless of the economic environment, and that's also why we're maintaining some of that liquidity right now. Laddering investments also helps us to achieve that goal. Now, let me turn to some of the warning signs. We are seeing growing signs of concerns in loan performance, capital, delinquency rates, and earnings across the system and at specific institutions. The latest quarterly performance data for the industry showed declining growth and weakening performance across auto lending, mortgages, and commercial loan categories. Further, these trends are contributing to a large percentage of credit unions with CAMELS composite ratings of 3, 4, or 5. In fact, by my calculation, on the slide you showed earlier, approximately 1 in 5 federally insured credit unions is a CAMELS code composite 3, 4, or 5. What especially concerns me about the information on slide 10 is the increasing number of complex credit unions with 500 million more or in assets falling into the troubled category, CAMELS code 4 or 5 ratings this last quarter. In fact, the number of troubled complex credit unions tripled from 3 to 9 in the last quarter alone, and the amount of assets at these institutions grew by more than 5-fold. It's been about a decade since we saw this proportion of insured shares at risk, so we must remain vigilant as we navigate this situation. Eugene, we've been watching the amount of shares and composite CAMELS code 3, 4, and 5 credit unions rise for several quarters now. expect these rating declines to level off or even improve?
So I think that is really difficult to say. And I think a lot of the factors that you mentioned are at play. Credit unions are going to need to, think with a declining interest rate environment, there comes, a different set of challenges than what they saw in the increasing interest rate environment. So I think all those factors that you talked about in terms of their earnings, there'll be changes in borrowing costs and in their lending program. Really difficult to say kind of if this represents a bottoming out of the trend or if it'll move one direction or the other. But certainly a need, as you say, to remain vigilant on it and for us to continue to monitor the potential liquidity of the fund in case there is a failure of size.
Yeah, but let me drill down a little deeper. We have a policy for $1 billion plus credit unions that we examine them on an annual basis, and it's been now more than a year since we've hit those institutions. So we've probably, if we've had changes and downgrades because of the liquidity events and issues related to last year, that's been brought in already. However, for credit unions less than $1 billion that are performing fairly well, they're on an extended cycle. There may be some of those who aren't performing well, so we might see some increases still occurring there. But in terms of liquidity, do you sort of see the issues leveling off there?
Yeah, I think there's additional concerns, though, that they're seeing in credit unions, which includes everything from record keeping and management to other issues. So it's not just a single factor. It's a variety of factors, and those factors, may be unrelated to any movement in interest rates.
So what I'm hearing you tell, we're not quite out of the woods just yet.
I can't say that we are.
Okay. Credit union leaders must therefore continue to monitor their institution's performance and balance sheets and act expeditiously to prevent small issues from turning into big problems. The NCUA's supervisory teams, for their part, will continue to monitor credit union performance through our examination process, off-site monitoring, and tailored supervision. We will work to maximize the credit union system's preparedness and resilience for any bumps in the road that may lie ahead. We did that during the Great Recession when we had $14 billion plus credit unions that were in troubled status, yet none of them ultimately failed. After all, protecting the Share Insurance Fund against losses was then and is now a top priority for the NCUA board, just as it always will be. That concludes my remarks on this topic. I now recognize the Vice Chairman.
Thank you, sir. And Eugene, before I chat about this topic, I want to mention, Mr. Chairman, I believe you mentioned call report changes at the outset. Just want to remind people, submit comments is not all that difficult. We encourage people to do it. We do read them. They do matter. And one of the best things about reading comments is that, well, first of all, you should know they're public, okay? You put one in. Some people don't know that. It's the first time they've done it. But it also means you can read other people's. And I find it very useful because people say, this is such a no-brainer, such an obvious view on whatever the topic is. I say, okay, but there are people who feel the other way. And you should know that, and you can read it. It's very useful sometimes to know what the other argument is, even if you think your view is rock solid. NCUA.gov, you select regulation and supervision from the top menu, and then rulemakings and proposals. You find everything that is presently out for comment. These new changes that Mr. Chairman mentioned about the call report, they were just published this Monday. Might take a few days, but to be reflected. But the proposed changes to the CU profile, credit union profile, when you want to look up a credit union, just get the basic info, is currently shown as agency information collection activities. We might want to do something about that name. It's not intuitive to me.
Agreed.
Click on it. It takes you to regulations.gov. You find the comment button. You can comment quite easily. The Federal Register will show you comments by other people, and your comment, again, will be public. It's just something you should know. To the topic at hand, the SIF update. Obviously, yesterday, the Fed cut interest rates for the first time since March 2020. That was, if you recall, that was an emergency meeting on the Sunday when everything sort of broke loose with COVID. The Fed normally moves in 25 basis point increments. They usually cut or raise a quarter point at a time. I don't read too much into these things. There's a Fed meeting every 8 weeks. So, but a cut of 50, since I've been an adult, this is the first non-emergency time. The last 3 times they cut by more than 25 were all what we call emergencies. There was that COVID Sunday, the financial crisis, and just after 9/11.
since I've been an adult, the only times they've lowered by greater than 25. Again, I don't read too much into it. As Chairman Powell said, you could have done 25 in July and 25 now. But markets are pricing in further cuts ahead. That obviously affects us, and it affects our balance sheet, affects our earnings, and it certainly affects credit unions. For what it's worth, and this is just public data, I just checked, futures markets, by Christmas, the Fed has a December meeting, right before Christmas. The markets are pricing in the modal outcome, the most likely, is another 75 down, right? Christmas Eve, according to markets, the modal outcome is another 75 on top of the 50 they did. 1 year from now, September of 2025, the modal outcome is, make sure I get this right, is down another 200 from today, right? So currently the Fed, since the financial crisis now does a range of a quarter point. Before yesterday, it was 5.25 to 5.5. Today, 4.75 to 5. That's the range for the overnight rate. So this Christmas, 400 to 4.25. That's down 75 from where we are now. This is just market data. It moves all the time. I'm not predicting anything, okay? And then if we have this meeting next year, it will again be right after the Fed meeting, September 17th, 2025. The modal outcome on the futures markets is 2.75 to 3, okay? So read into that what you will. It does mean that we will have less money in our short-term investments. The reason I'm talking about rate cuts, rate moves at all, it matters to the Share Insurance Fund for two reasons. One, as stated, we parked a lot of money in overnights and other short-term investments, so the SIF is going to get lower income going forward in that sort of investing. Interest rates are just the price of money, and NCUA is a seller of money, meaning we lend it out. Like any seller of anything, we get hurt when prices are down. In our case, the only buyer is the U.S. government, the Treasury, and they, of course, are a buyer, which means they like it when prices go down. This is the same true of any product anytime. And the second factor, and somewhat countering the first factor, remember the first factor is lower short-term income for us. The second factor is that credit unions are now faced less interest rate risk than they did during the Fed's aggressive rate hike cycle. That was a major problem last year. It's one of the things that contributed to Silicon Valley Bank going down. It was a big topic for us. People wanted meetings about it. That was a major problem. It is much less so now. That's a positive thing for the Share Insurance Fund, but it's hard to measure and it's not reflected in today's SIF report. Our short-term income is going to go down, but so is the interest rate risk facing credit unions. And risk to credit unions is why we have a Share Insurance Fund in the first place. The big picture, despite economic uncertainty, is our fund remains well capitalized and continues to perform effectively. We have a net income of $86 billion this quarter. Our equity ratio, as mentioned, went down slightly from 1.30 to 1.28 as of June 30. Now, this remains well above the statutory floor, and it is below our normal operating level where we kick money back. It is higher than our projected 1.24. To review below 1.20, Congress mandates that we put together a plan within 6 months to restore it, right? Which historically has meant billing everybody. So we're well above that. First off, Eugene, all right, so the mismatch. We projected 1.24, came in at 1.28. Review the reasons that we missed by 4 and why we missed to the downside. I mean, it came in above.
Sure. So thank you for that question, Vice Chairman, and the opportunity to provide some thoughts on this matter. Regarding the change between the 630 projection versus what we saw as the actual, the primary factor was a difference in insured share deposits. The projection was based on a higher growth rate in insured shares than what actually occurred. Rather than 5% growth, which was projected, the actual growth was 2.1%. The higher rate of insured share growth tends to depress the equity ratio, as we saw clearly during the pandemic. Also contributing to the higher 630 equity ratio was a low loss environment, so we had fewer losses than the model projected, and also slightly higher income than what was forecast. And so for awareness, slide 19 has supplemental information, today's presentation that shows the change in insured shares.
We only had, like you said, 2% growth the first half of the year in shares. We haven't seen a big movement out of credit unions. That, for a number of reasons, that means credit unions at least doing a good job playing offense and defense to prevent people leaving for high-yielding options elsewhere. But 2%, what's affecting credit union growth right now?
So I think, as always, that deposit growth is a function of multiple factors. For example, household income, changes in household income, unemployment rates, interest rates. There's also a seasonality to the insured share rate. The cumulative impact of inflation on household expenses is likely playing a role today. So while inflation rates have fallen significantly, the burden of daily expenses remains high for many households, and that can translate into lower balances. The slowdown in insured share growth, I believe, is also similar to trends that the FDIC is seeing in their deposit fund, and so it's not unique to credit unions.
So I know we've resumed purchases in our bond ladder, and overnights remained about the same. So we've obviously seen a reduction in all the unrealized losses we had. We had the same interest rate problem that credit unions do, but we have the advantage of holding the maturity. The same way they're holding mortgages like mine, just under 3%, and that hurt on their balance sheet. We were holding paper we bought for 1% yield for 5 years and that sort of thing. How do we prepare for this new rate environment, whatever it is?
So I think we prepare by first looking at the liquidity needs. So again, safety, liquidity, yield is what we generally look at when we consider how to make the investments of the share insurance fund. A few notes on the unrealized losses. So the unrealized loss position peaked at about $1.7 billion in 2022.
So that'd be a little under 10% of our bonds were underwater. They were worth less than we paid for them.
So the overall value of the portfolio was, like, every single bond
Yes.
was underwater itself.
Right.
But the overall position was, roughly almost 10%. And as of June 30th, so that's receded now from that high water mark by about $500 million. And the change in the second quarter alone was around $60 million. Now, since June, we're estimating that the unrealized losses have come down yet again by almost $500 million more dollars, which will eventually be shown in the third quarter financials. But of course, that's subject to change depending on how interest rates behave between now and the end of the month. So that unrealized loss, that was a key factor in driving up our overnight holdings, because we wanted to have liquidity in case there was a need for it without having to sell at a loss and realize an unrealized loss. Now that we're going to see sort of an increased range in liquidity options within the portfolio as we move away from the extent of the loss position, I think we'll have to reassess what the appropriate amount is to have in the overnights.
Did we have kind of a Goldilocks thing for a while there, meaning that as every insurer, you have to have liquidity, you need cash on hand to pay out? Families have emergency funds, that sort of thing, that's not in the stock market, et cetera. But normally with an upward slope yield curve, that liquidity costs you money because you're not earning much on it.
Right.
We had a situation there for a while where having lots of liquidity was also the highest yielding. That is not normal.
Right.
And we had a Goldilocks thing that may not be the case anymore.
Well, I mean, as of today, it still is. The yield
It's still
curve
the
is
highest
still,
point.
it's
Yes.
still inverted. And so, I mean, that sort of plays into the, again, safety, liquidity, yield. We weren't paying that premium that you would normally expect to pay by having as much as we had in overnights. The overnights were paying more.
Yeah.
So, and again, looking at that, how that behaves going forward, is another part of the sort of the equation in how to balance or consider rebalancing the overnight portfolio.
Thank you, Eugene. Last thing, I just want to acknowledge the hard work you guys put into the mid-session budget update. Looks like we're currently running a $5 million budget surplus, compares to $23 million surplus last year. What line items have decreased, and where are we seeing increase in the budget?
So thank you for that. And the budget is executing closer to the levels approved by the board for 2024 than it did in 2023, meaning that we do expect a smaller year-end balance. In recent years, the agency has generally underspent its budget for pay and benefits, travel, and contracts. To answer your question, I think comparing where we're at as of July 2024 to where we were at in July 2023, over year comparison. The couple of key changes would be, first, pay and benefits costs have increased by just over 9% through this point this year versus last year. And a lot of that is reflective of the concerted effort that the agency made to fill vacant positions last year. And we're maintaining that low vacancy rate this year, so that effectively has increased our actual payroll costs. Travel expenses are increasing. They're up about 5% so far year-to-date this year versus last year. Contract spending, which often is one of our more rapidly expanding budget line items, is actually only up 1.8% for this year. And so while it's still an overall increase, it's lower than in recent years, and the agency has seen some reductions in specific contract recompetitions so far this year that have helped keep that growth down.
Pay and benefits up 9, partly because we had a lot of vacancies last year. I was going to say, did you get a 9% raise? I didn't. I hope I did.
I have to say that my pay has remained flat.
Yes.
For the last, how many? I think it's been
Set
12
by
years
Congress,
since
so
Congress
they have to
has
do it.
raised it, so yeah.
It is what it is. Back to you, Mr. Chairman.
Thank you so much. If I could just build on a little bit more what you said about rates. I think rate drops are good for borrowers. And credit unions are going to need to prepare for what could be a wave of refinances when it comes to auto loans, as well as mortgages. It also could mean more mortgages getting made as more buyers are be able to stretch their dollars further and reach into the housing market. And certainly, of course, it will for those that have a floating rate, even though we have an interest rate cap ceiling, we'll see credit card rates coming down. That could cause some difficulty. Also, too, we could see some disintermediation happening for savers within the markets who are going to take money out of their short-term yields that have been doing really well and move it to places where they might do better. I think that credit unions overall, as I looked at the last quarter numbers, had been increasing the amount of cash on hand as well as overnight investments so that they can handle these changes that we anticipate coming into the market. That concludes our first item of business today. The second item of business is Final Rule, Part 745, Simplification of Insurance Rules. Staff presenting are Tom Zells, Senior Staff Attorney, Office of General Counsel, and Paul Dibble, Consumer Access Program Officer, Office of Credit Union Resources and Expansion. I have to give it to you, Tom, for having a great soccer game today, and Paul for having a fantastic shirt-tie combination. Good morning to both of you. Please start whenever you are ready.
Thank you so much. Good morning, Chairman Harper and Vice Chairman Hauptman. We are here today to present a final rule to amend Part 745 of the NCUA's regulations governing share insurance. The primary intent of the final rule is to simplify the NCUA share insurance coverage rules related to trust accounts. Before we get into the specifics about the final rule, I'm going to provide a little bit of background on how the Federal Credit Union Act, or FCU Act, addresses share insurance and a general description of the current share insurance rules. Under the FCU Act, the NCUA is responsible for paying share insurance to any person with funds lawfully held in a member account in the event of a federally insured credit union's failure, up to the standard maximum share insurance amount, which is currently set at $250,000. In general, the FCU Act is not overly prescriptive on how the share insurance process works, but does specify specific treatments for a few types of accounts. For example, accounts held by government depositors and certain retirement accounts. Otherwise, the FCU Act provides substantial discretion to the NCUA. The NCUA has implemented share insurance requirements in Part 745 of its rules. Generally, the NCUA determines whether a member account is insured by grouping particular categories of accounts held by a member, such as single ownership accounts, joint ownership accounts, revocable trust accounts, and irrevocable trust accounts. If an account meets the requirement for a particular category, the account is insured up to the $250,000 limit, separately from shares held by the member in a different account category at the same federally insured credit union. For example, provided all requirements are met, shares in the single ownership category will be separately insured from shares in the joint ownership category held by the same member at the same federally insured credit union. We will now discuss specifics of the final rule. I'll turn it over to Paul so that he can discuss the changes to the trust account coverage.
Thank you, Tom. Good morning, Chairman Harper. Good morning, Vice Chairman Topman. The share insurance process is fairly straightforward for most types of accounts. One exception, however, is trust accounts. The NCUA's current regulations recognize two different types of insurance categories for funds held in connection with trusts: revocable trusts and irrevocable trusts. The share insurance rules include additional complexity related to the number of beneficiaries that would receive funds from revocable trusts and whether irrevocable trusts include certain contingencies. Despite previous NCUA efforts to address confusion related to trust accounts, the NCUA has received over 8,500 share insurance questions related to trust accounts since the end of 2019. Additionally, the complexity also causes a potential for delay in insurance payouts when the NCUA has been appointed as liquidating agent. The FDIC, which has deposit insurance coverage rules that are comparable to the NCUA's rules, has experienced similar issues related to its rules on trust accounts. The final rule makes several changes to simplify the treatment of trust accounts. First, the final rule merges the revocable and irrevocable trust categories into a new trust accounts category. This new category includes informal revocable trust accounts, such as payable on death accounts, formal revocable trust accounts, and irrevocable trust accounts. The final rule also treats irrevocable trusts like revocable trusts in the fact that contingencies would no longer impact potential coverage. While the change creates simplicity, as all trust accounts regardless of legal form will be treated the same, it has the potential to reduce share insurance coverage as the existing rule provides for the potential for increased coverage depending on whether the member set up revocable or irrevocable trusts. So for members who establish both large revocable trusts and large irrevocable trusts to the same beneficiaries, the final rule may result in reduced coverage. However, for other members with irrevocable trusts, the final rule could result in increased insurance coverage, as irrevocable trusts with contingencies to multiple beneficiaries will now have greater insurance coverage. Second, the rule simplifies the treatments for shares held in trusts with more than 5 beneficiaries. Under the final rule, additional share insurance coverage would not be provided if a member leaves trust funds to more than 5 beneficiaries, regardless of the number of trusts that establish those funds. Therefore, the maximum amount of share insurance coverage for trust funds under the final rule would be $1.25 million. This change streamlines the rule, but has the potential to reduce share insurance coverage for certain members. The proposed rule included a question on the potential effect of this change. As expressed in the proposed rule, we do not believe in practical terms that this change will have a substantial effect on the share insurance coverage for most members. The comments received also did not provide an indication to the contrary. Therefore, under the final rule, the calculation of insurance coverage for trust accounts is similar to the rule currently used for revocable trusts for 5 or fewer beneficiaries. An account holder's trust account will be insured in the amount up to $250,000 multiplied by the number of trust beneficiaries, not to exceed 5. This is regardless of whether the trust is revocable or irrevocable, or regardless of contingencies or the allocation of funds among the beneficiaries. This, in effect, limits coverage for each grantor's trust accounts at each federally insured credit union to a total of $1.25 million. This treatment of trust for share insurance purposes creates more parity between the NCUA and the new trust rules adopted by the FDIC that became effective on April 1st, 2024. The final rule adopts the changes recommended in the proposed rule as proposed. Under the final rule, the effective date of the trust account changes will be delayed until December 1st, 2026. This delayed effective date provides a very similar implementation timeline to the one provided by the FDIC and would provide the NCUA, staff at credit unions, and credit union members necessary time to prepare for the changes. I will now hand it back to Tom so that he can discuss the comments received on the proposed trust account changes and some other changes made by the final rule.
Thanks, Paul. In terms of comments on the trust account changes, all 11 substantive comments that the NCUA received indicated support for the changes. Common reasons that the commenters provided for supporting the rule included providing parity with FDIC coverage and reducing confusion regarding coverage of trust accounts. As noted, commenters did not express real concern with the new trust rules effectively limiting each grantor to a maximum of $1.25 million in coverage for their trust account funds. One commenter specifically stated that they did not think the $1.25 million per grantor cap was too low, as the vast majority of accounts are well below the level, but did ask the NCUA to track liquidations to ensure it is not too low. Other issues commenters addressed included membership requirements for trust accounts, reporting of insured shares on the call report, and whether the NCUA should provide a delayed effective date or otherwise insure already existing accounts or legacy accounts under the current rules. The final rule also makes a few other changes in addition to the simplified approach to trusts. The final rule clarifies the coverage provided to mortgage servicing accounts for funds that the mortgage servicer or another party deposits on behalf of the borrower. The NCUA's current rules include a separate insurance category for mortgage servicing accounts that are comprised of principal and interest funds. The current regulations, however, do not address funds paid in to a mortgage servicing account by someone other than the borrower. By not treating funds deposited by the servicer the same as funds deposited by the member, NCUA's current rules result in inconsistency and the potential for instability during periods of economic stress. The final rule clarifies that these funds receive similar share insurance treatment. This is identical to the treatment under the FDIC's recent final rule. The NCUA received 6 comments specifically addressing this change. All of these comments supported the change. The final rule makes no alterations to the changes recommended in the proposed rule. As this change would provide more expansive coverage and should not impose additional burden on credit unions or account holders, the final rule does not delay its effect. It would become effective 30 days after the final rule is published in the Federal Register. The final rule also makes some changes to the NCUA's record-keeping regulations for share insurance coverage. These changes are favorable to members and provide more flexibility to the NCUA to include additional documentation evidencing the intent of the account when making share insurance determinations. These changes pose no additional burden to credit unions. The NCUA received 7 comments specifically addressing these changes. All of these comments supported the changes. The final rule makes no substantive changes to the changes recommended in the proposed rule. As these changes only explicitly clarify the flexibility the NCUA has in terms of records the agency can look to in evaluating share insurance coverage and would not impose additional burden on credit unions or account holders, the final rule does not delay its effect. It would become effective 30 days after the final rule is published in the Federal Register. That concludes our presentation. We are happy to answer any questions you may have.
Thank you, Tom and Paul, for your presentation on the final rule to simplify certain share insurance requirements related to trust accounts and mortgage servicing accounts, among other things such as the record keeping you just mentioned. And thank you to the many team members across the agency who worked collaboratively to bring this final rule before the NCUA board today. It's a common sense package of regulatory changes that I fully support. By establishing a unified trust accounts category that treats coverage of funds in both revocable trusts and irrevocable trusts deposited at federally insured credit unions in the same manner, this final rule simplifies the share insurance regulations and brings the National Credit Union Share Insurance Fund into greater alignment with the Federal Deposit Insurance Corporation's Deposit Insurance Fund's rules. That's a positive change not only for credit union staff, who will have streamlined procedures when working on such trust accounts, but it's also a benefit for credit union members who will better understand their coverage options. It's also a time saver for the NCUA's share insurance fund specialists share insurance specialists who during the last 5 years have fielded thousands of calls, as you've noted, Paul, about share insurance coverage for different types of trust accounts. This rule change will also lead to greater efficiency in the NCUA's Asset Management Assistance Center when managing future liquidations. Specifically, the final rule, as I mentioned, eliminates distinct and separate sets of rules and insurance coverage calculations for shares of revocable trusts and irrevocable trusts. Those rules led to public confusion about the share insurance coverage of trust accounts maintained at federally insured credit unions. This final rule aligns the coverage standards for both types of trust accounts and establishes a simplified formula for calculating coverage for funds deposited at federally insured credit unions. This final rule also allows for more time for more timely share insurance fund determinations by the NCUA of trust accounts, which will facilitate faster payments to account holders in the event of a credit union liquidation. In fact, Paul, as I understand, we've sometimes had to spend months sorting through trust records to determine just how much exactly we've had to pay in a payout. In addition, this rule provides members at federally insured credit unions with the same protections as consumers who use trust accounts at banks and thrifts. Such parity between the two federal deposit insurance programs promotes greater public confidence in the dual systems for protecting shares and deposits. And as one commenter noted, such parity is crucial for maintaining consistency and fairness in the financial system. I couldn't agree more. Public trust in our financial system must never be taken for granted. We saw firsthand the effects on consumers and turmoil in the markets caused by several large bank failures last year. Deposit insurance at federally insured credit unions and banks is vital as it stabilizes the financial system during periods of economic uncertainty and financial stress. More importantly, it gives consumers confidence to entrust their hard-earned savings and nest eggs to a federally insured financial institution. Additionally, the final rule modifies the treatment of share insurance coverage for mortgage servicing accounts, bringing those standards for the credit union system into greater alignment with the banking system when it comes to deposit insurance coverage. Credit unions have had pronounced increases in their mortgage lending and servicing in the 16 years since we last updated this portion of the share insurance coverage rule in 2008, so this change is an important one. By giving credit union members and members of the public who use trust accounts and credit unions who service mortgage accounts in the same level of protection, whether the accounts are maintained at federally insured credit unions or banks, we must ensure parity to the extent possible and maintain confidence in our nation's credit union and banking systems. I therefore support this change to our rule. That said, before closing, I do have several questions. First, will the merger of revocable and irrevocable trust categories into one single group for share insurance affect the application or operation of state law?
No, it should not. The rule really just affects the NCUA's coverage of share insurance and should have no impact on state law.
So federalism standards, states can still set their own laws. This is just for ourselves. Thank you. It's good to know that our regulatory change will not affect state law in any way. Second, many credit union staff and members rely on the NCUA's Your Insured Funds brochure, as well as mycreditunion.gov to answer questions about share insurance coverage. Once we publish these regulatory changes in the Federal Register, how quickly do we anticipate having both resources updated?
I can take that. We're fully committed to updating the Your Insured Funds brochure and mycreditunion.gov as quickly as possible. Appreciate the importance of those resources to credit union staff and members. Staff have already started working on the scope of defining the necessary updates, and assuming the board approves this final rule today, we will immediately start on updating all the relevant materials.
And if I recall, the Your Insured Funds brochure it's a lengthy document, so it may take a little bit of time.
46 pages, I think?
Yeah.
Currently. We also recognize the importance of developing materials that accommodate the delayed effective date for both, for the trust account changes. We're committed to making sure that those resources are available that both help clarify existing share insurance coverage and what future share insurance coverage will be. We plan to post the updated materials as they are ready. CURE staff will also continue to be available to answer any share insurance questions that staff and credit union members may have.
Yeah, and I know that the FDIC provided for a long time frame for implementation of its change.
Correct.
Are we providing an equally long time frame?
Yes, I believe it's almost identical.
Yes, it's almost identical to the FDIC one.
Great, thank you. I know that I would like to have the updated resources in place as soon as possible and appreciate the hard work of the NCUA team that will go into completing those tasks. Finally, in the preamble to this rule, we note that the 1.25 million per grantor cap is unlikely to be too low. What evidence do we have for reaching that conclusion, Tom? What, for example, is the median size of a trust fund or the amount of the average inheritance?
Sure. So the final rule actually cites survey data indicating that the median size of a trust fund is around $285,000, which is obviously well short of the maximum coverage available under the rule. Additionally, commenter input addressing this issue agreed that the $1.25 million per grantor cap was unlikely to be too low, as the vast majority of accounts are well below that level. This aligns with staff's general experience as well. That commenter did, however, ask that the NCUA track liquidations to ensure the cap is not too low, and the final rule actually notes that the agency does plan to continue to track uninsured amounts in liquidations, if any, and can explore further changes if that should become warranted.
And in fact, the call report changes that the Vice Chairman and I have been both talking about have changes related to uninsured shares. Thank you for those answers. That concludes my remarks. I now recognize the Vice Chairman.
Thank you, sir. What was 46 pages? You mentioned?
Your insured funds brochure. Don't quote
got
me.
you.
I think it's somewhere on there.
It's a pretty lengthy guidance
It's
document.
lengthy.
Yeah, today's rule, I was looking at, that's 72 pages. I know it can be, it gives me pause. Hey, we're simplifying things. Here's a 72-page government document on the simplification. It can feel a little weird, but I will, I think this is a positive change. I'm going to be supporting it. I'll say regulatory relief can come in a lot of forms. The best kind is what we're doing today, which is regulatory relief that isn't taking on more risk or reducing government oversight. It's just adding clarity. I think this is a good time to remind ourselves that the question of how easy it is to follow the rules is determined solely by those who have to follow them, not that those of us who write them. NCUA insurance specialists in the last 5 years have received over 17,000 calls. Staff estimates that over half of those are related to coverage for trust accounts, revocable and irrevocable. And that 17,000, again, just over half, we think are related to this issue, trust accounts. That does not include inquiries we got via email. It does not include inquiries from mycreditunion.gov or inquiries received by NCUA staff directly. It also doesn't include credit unions that had questions but got the answer from another credit union. Nor does it include credit unions that had questions but were too nervous to tell their regulator about it. That, by definition, happens more often than regulators realize. So today's action is smart regulatory relief. We at the NCUA are also saving ourselves time and effort. Both rules on today's board agenda provide much-needed improvements on consistency, simplification, and clarity. Today's final rule on insurance coverage is substantially unchanged from the proposed rule. Thank you to the 13 stakeholders who submitted comments. These comments were universally supported, provided some suggestions for some changes. They appreciated the benefits of a simpler calculation and being at parity essentially with what the FDIC does. This rule simplifies and reduces the number of rules governing the treatment for trust accounts. The regulation establishes a single category for trust accounts using a common calculation for both revocable and irrevocable. The final rule is also intended to streamline the currently time-consuming trust review process and facilitate faster payouts to beneficiaries. By reducing unclear and confusing elements of this rule, credit unions, their employees, and NCUA staff are better able to serve the public. The ultimate beneficiary should be credit union members. One last thing on this topic directly. The way we really help small credit unions is not by increasing our budget and adding lots of more exam hours to answer questions about our own rules that we wrote. The way to help is you make it less burdensome to operate and start a small credit union. Succession planning is also easier when NCUA can help make the job of running a small credit union a more attractive job. Sometimes these are labors of love in some small credit unions, and it could be a little bit more than that. That concludes my remarks directly on this, except just to make a public service announcement, which is, folks, please update your beneficiaries. When my mother passed away of her 3 children, for some reason, I was the one that had to do all the paperwork, and she didn't have a whole lot of money. But boy, was it easier that the 3 of us were named as beneficiaries, including her credit union account, got the money quickly to, as Dave Ramsey says, you know, the one thing you want to leave your heirs is peace and simplicity. So my mother thankfully updated her beneficiaries. That was a good scenario, and nobody wants to be, you know, the worst case. If you remember Atlanta, 2016, woman hired a guy, had her new husband killed for the insurance money, but the check went to the ex-wife, you know, so. Moral of the story, update your beneficiaries, you know, so. A couple questions. All right, member has a trust account worth over $1.25 million, right? Mm-hmm. It's got more than 5 beneficiaries at a single credit union. Is there a mechanism to allow credit unions and members the ability to restructure their accounts to accommodate the changes?
I can take that question. It's true that there may be some instances where a single member with more than 1.25 million in trusts, a single credit union may see their coverage reduced. However, because of some of the simplifications of what are currently insured as irrevocable trust accounts, coverage could actually increase in some cases too. Regarding restructuring accounts, members with funds in excess of the maximum insured amount would have until the new trust account coverage provisions go into effect to restructure their accounts. The trust account changes in the final rule would not go into effect until December 1st, 2026, over 2 years from now. The delayed effective date mirrors the one the FDIC provided in their own rule. Members with funds over the insured limit have multiple potential options for rearranging their accounts. Depending on their specific facts and circumstances, they may just want to move the excess funds into a different federally insured credit union to ensure that all of their funds are insured. Alternatively, they may be able to restructure their funds within their current federally insured credit union so that the excess funds are insured under a different insurance category, such as the single ownership account category. In the rare event a member has a share certificate that exceeds a 2-year delayed effective date and has trust funds that are over 1.25 million that would be uninsured, the member may need to work with their credit union to determine the best path to restructuring the impacted funds in advance of December 1st, 2026. I do also want to stress that I'm only referring to the restructuring of trust accounts at a federally insured credit union. The final rule's impact should be limited to the insurance coverage of those accounts, should not require an individual's actual formal trust document to be restructured. Finally, I think it's worth noting that where 2 individuals are co-owners of a trust account, such as a payable and death account with updated beneficiaries and correct beneficiaries, each co-owner is entitled to up to 1.25 million in coverage if they have at least 5 beneficiaries. In other words, a couple could have as much as 2.5 million in coverage of their trust accounts at one federally insured credit union. That concludes my response.
Gotcha. One of the commenters suggested grandfathering existing trusts. What's the reasoning for not doing the grandfathering?
Sure, I can take that one. So it's correct, we had 3 commenters that expressed support for some form of grandfathering of existing accounts. In discussing this, the final rule preamble refers to this as legacy coverage. Those comments were strongly considered. However, it's staff view that providing legacy coverage for existing accounts poses complications and burdens to federally insured credit unions, account holders, and the NCUA that makes such a system largely unworkable. In short summary, legacy coverage would undo the benefits of simplifying the proposed rule. To provide legacy coverage, the NCUA would have to effectively maintain 2 sets of rules, the new simpler trust rules and also the entire current regime of trust rules, which have generated so much confusion and resulted in so many questions. With 2 sets of rules in place, there's yet another step which would involve adding the multiple existing account, which would add to the multiple existing steps we already have under the current rules for trust accounts. So in evaluating coverage, NCUA credit unions and members would then first have to ask whether an account was in existence at the time the NCUA adopted this new rule, or the new trust account coverage rule. Accounts that did exist at that time would still have the existing complicated analysis applied to their funds. In addition to largely undermining the simplification, clarity, and burden reduction benefits the rule would provide, legacy coverage would also pose yet new questions that could further complicate share insurance rules. So just by example, the rule would need to address what impact change in beneficiary, an account restructuring, or other similar action meant for the legacy status of the account. So it basically add yet another complication to an already complicated set of rules. I also want to reiterate that the NCUA has consistently tried to make sure that where it's possible, there's parity between NCUA coverage and FDIC deposit insurance coverage. If we were to provide a legacy account situation, we would then not have complete parity with what FDIC is currently doing. Our hope is that by providing a substantially delayed effective date, which is in excess of 2 years, federally insured credit unions and their account holders should have enough time to make any needed changes to their accounts to essentially make legacy accounts not necessary.
Yeah, I think it's a fair answer. I think the comment is not unreasonable. It's one we sort of expected.
Right.
But I get it. We're trying to reduce everybody's effort. And somebody would say, well, my neighbor just told me they don't have to do this. And then we'd have to explain that to them. The person answering this question would have to know that way back in the day, this conversation could be in 20 years.
Yep.
And it also creates some strange situations where maybe you want to take your business elsewhere, but you're tied in to this old legacy account and you don't want to disturb that. So I agree. The person who sent that in, not a strange request. Grandfathering is routinely done in state and federal law, but our purpose here is simplification, and I think it's the right call. And where are we? Just give me a rundown. Updates to the forums, the website, our internal training, because people are going to maybe ask questions about this change. Where are we on preparing people for that?
We have the scope defined. So as soon as, assuming you approve the rule today, we'll get started on creating those materials right away.
Thank you both for that. Back to you, Mr. Chairman.
Thank you, Mr. Vice Chairman. Is there a motion?
Yes, sir. I move that the board approve final rule, part 745 of NCUA's rules and regulations as attached to the board action memorandum.
I second the motion. All those in favor say aye.
Aye.
Aye. All those opposed say nay. Let the record show that the ayes have it, and the motion passes 2-0. The last item of business today is final rule parts 701, 741, 746, 748, and 752, fair hiring and banking. Pamela Yu, Special Counsel, Office of General Counsel, will present the item, and John Berry, Policy Officer, Office of Examination and Insurance, will be available for any questions the board may have. Good morning to both of you. I see that you are on point with your NCUA blue today, Pamela. And I gotta say, I had no idea you could actually find a matching tie and sock combination. John, well done. Good morning, and please begin whenever you're ready.
Thank you. Good morning, Chairman Harper, Vice Chairman Hopman. John and I are here today to present a final rule to improve employment opportunities for individuals subject to Section 205D of the Federal Credit Union Act. As you know, Section 205D generally prohibits any person convicted of certain crimes involving dishonesty or breach of trust from working or volunteering at a credit union without the prior written consent of the NCUA. The employment prohibitions have existed in some form since 1970, and the agency's current policies on Section 205D are found in a 2019 interpretive ruling and policy statement that we refer to as IRPS 19-1. In December of 2022, the Fair Hiring and Banking Act was signed into law and amended Section 205D to expand career opportunities for those with prior minor or older criminal offenses. The Fair Hiring Act also made parallel amendments to Section 19 of the Federal Deposit Insurance Act. The legislation specifically required the FDIC and the NCUA to consult and coordinate to promote consistent implementation of the law. Under that mandate, the NCUA developed this rulemaking in coordination with the FDIC. We also consulted with the Federal Reserve and the OCC to identify common interpretations and areas for cooperation. The FDIC issued its final rule amending its regulations regarding Section 19 on July 30th of this year, and our final rule today is consistent with the FDIC's rule. The most significant changes that the Fair Hiring Act made to Section 205D include excluding certain older offenses from the scope of the prohibition, such as those older than 7 years. It also excluded certain expunged, sealed, and dismissed offenses, excluded certain de minimis offenses, including specific, specified, designated lesser offenses. It also designated certain criminal offenses like most drug possession and older misdemeanors as not involving dishonesty and therefore outside of the scope of the prohibition. It also specified standards and procedures for the NCUA's review of applications for board consent. In October of last year, the board approved a proposed rule to codify Section 205D and incorporate both the IRPS and the fair hiring provisions into the NCUA's regulations in a new part, appearing as Part 752 in the Code of Federal Regulations. The proposal also made various conforming amendments as well as minor changes to Section 701.14. That's our regulation addressing changes in an official or officer in credit unions that are either newly chartered or in troubled condition. Those changes were proposed to clarify when a notice is required, how the NCUA would process the notice, and what information must be included in any notice of disapproval. The board issued the proposed rule for a 60-day comment period, which closed on January 8th, 2024. We received 10 public comments on the proposal. We received comments from individual members of the public, Fidelity Bond Provider, an association advocating for the rights of the accused and the incarcerated, and national, state, and regional organizations representing credit unions. All of the commenters were generally supportive of the proposal, and most expressed broad support for providing second chances and increasing job prospects for those with criminal offense backgrounds. Several commenters did suggest changes to particular provisions or asked for clarifications on certain aspects of the proposal, and a number of those very helpful comments resulted in modifications and improvements to the final rule. Substantively, however, the final rule is largely consistent with the proposed rule and the FDIC's parallel rule, as well as the statutory provisions in the Fair Hiring Act. Along with this final rule, we're also amending the board's delegations of authority to authorize the regional directors and director of the Office of National Examinations and Supervision to approve or disapprove individual and credit union-sponsored consent applications. Formerly, those field office directors only had delegated authority to act on credit union-sponsored applications. Under the revised delegation, field office directors will have authority to act on both types of consent applications, which will streamline the application process and improve efficiency for the agency. The revisions to the delegations also require the prior concurrence of the general counsel for any disapproval of a consent application by a field office director. As required by the Fair Hiring Act, the general counsel's concurrence must certify that the denial is consistent with Section 205D. Finally, in any case where a consent application is denied, the denied applicant may request reconsideration from the field office or appeal the adverse decision to the board. The board will act on any appeals in accordance with our appeals process that we have contained in Part 746 of our regulations. Once finalized, Part 752 will supersede IRPS 19-1, and the current IRPS will be rescinded. The final rule will become effective 30 days following its publication in the Federal Register. Thank you, and John and I would be happy to answer any questions.
Thank you so much, Pamela, for your presentation on this final rule to implement the statutory requirements of the Fair Hiring and Banking Act. The Federal Deposit of Insurance Corporation, as you noted, recently completed its work on a similar rulemaking, and it's good to time our actions to be in tandem with our sister agency. And John, thank you for being available to answer any questions. I appreciate all the work by the teams in the Office of Examination Insurance and the Office of General Counsel in bringing this rule before the NCUA board. Providing career opportunities for those who want nothing more than a second chance to be responsible, to earn an honest wage, and to pursue a rewarding career in the credit union system is a tale of redemption and inspiration. It's also a matter of equity, and it proves people have the capacity to make amends and change the direction of their lives for the better. The final rule before the board today aims to do all that, and I will support it. This rulemaking aligns with the Fair Hiring and Banking Act and defines what criminal offenses are covered by the regulation, such as criminal offenses involving possession of controlled substances and other minor offenses. It adds a new Part 752 to the NCUA's regulations and codifies the agency's policies and procedures for consent applications related to prohibition orders. Further, this final rule modifies the NCUA's rules governing the conditions under which newly chartered or troubled federally insured credit unions must notify the NCUA of proposed changes to their board of directors, committee members, or senior executive teams. We are also updating the processes to streamline the implementation of this rule. Under this final rule, the heads of the NCUA's regions and the Office of National Examinations and Supervision will have the authority to approve or disapprove both individual and credit union-sponsored applications meeting certain criteria. And the NCUA board itself will maintain and have the power to approve or disapprove individual applications for consent involving more severe criminal offenses and other high-level security cases it designates. The final rule also ensures the due process by laying out an appeals process for consent decisions. Providing a second chance not only goes hand in glove with the credit union purpose of advancing economic opportunity for all, we each make mistakes at one time or another, and most of the individuals who will benefit from this rulemaking are those who have committed minor offenses, paid their debt to society, and are now seeking to improve their lives by finding gainful employment in an industry that has people helping people at the heart of its mission. Before concluding, I do have two questions that I'll pose as one. In this rule, we note that after finalizing it, the NCUA will issue guidance to credit unions. What will that guidance cover, and what is the timing for when we will issue it?
Sure. Thank you, Chairman. I'll take the question. So yes, as you mentioned, the final rule does note that there are a few areas where IRPS 19-1 provided additional context and discussion on our policies and procedures related to Section 205D as opposed to FDIC's regulation. So in general, the additional information we had in the IRPS did not provide any substantively different information from the FDIC's rule, but instead provided just clarifying information and explanatory information. In the final rule, we have omitted much of that information just to ensure our consistency with the FDIC's parallel rule. But we do think some of that additional guidance may help credit unions in complying with their responsibilities under this statutory prohibition. So as such, we're preparing guidance that will essentially preserve that information that was in the IRPs and did not transfer over to the new regulation. So for example, the IRPs provided that when a credit union learns that a potential employee has a prior conviction, but they've determined that the offense was de minimis, the credit union should document in its files that a consent application is not required because the covered offense is considered de minimis and that it meets all the criteria for the exception. So the IRPs also discussed extending conditional offers of employment that are contingent upon a satisfactory background check and other types of examples and clarifying information and details. We don't intend to change a position in any of those policies, even though they're not included in the final rule. So the guidance that we'll be issuing will be available as sort of a supplement to the regulation. We hope to finalize that guidance soon, and then we will plan to have it available to the public on our website.
So soon can mean different things to different people. Soon, do we mean within the next quarter or the next month?
I would expect soon, in the next quarter at least.
In the next quarter,
Yes,
okay.
it's well on its way.
Yeah, I know that we've had, from time to time, applications that have come to the board here on this very topic. And the sooner we act, the sooner individuals can get the relief and gain employment in the credit union industry if they are interested. Thank you for those insights. In closing, this rule goes a long way in advancing financial inclusion and equity within the credit union system, and I wholeheartedly support it. I also do want to recognize the work of our former colleague, board member and former Chairman Hood, who certainly put this issue front and center when he was chairman. That concludes my comments. I now recognize Vice Chairman Hauptman.
You bet. Also like to commend Rodney Hood for that. I know hopefully after we're gone someday, people will compliment things we did. Rodney, if you're out there, well, Rodney's probably at an airport ready right now, waiting for his flight to depart. But nice work there. Thank you to you two. Good seeing you. I guess you have matching socks. That level of commitment to fashion.
It is an archive of socks.
No, it didn't matter. It's just, we were talking about simplification, both of these things are, and I very much am so into it. Years ago, I took all of my dress socks, threw them out, all of them, replaced by like 40 pairs of the same black gold toe. I no longer have pairs of socks. Laundry is easier. I grab any two. You get a hold. The dog grabs one, runs off. Doesn't matter. They're all the same. Grab any two. It's one part of my life that is simplified. That is how I live. I have respect for you guys who put that kind of attention on it. I appreciate the work you did coordinating. I know this is with other agencies, FDIC, OCC, and the Fed. This is the kind of regulatory consistency that benefits credit unions and the general public. So this comment period opened last November, closed on January 8 of this year. We got 10 comments. Thank you for putting those in. They are read, they are considered. All 10 expressed their support for what we're doing today. One commenter suggested clarifying language around the requirement for fidelity bond coverage. The commenter felt the language was not clear, that eligibility for credit union service did not make the candidate automatically eligible for fidelity bond coverage. The board agreed, and that language was clarified around that issue. There are a couple more reasons I'm pleased to see this rule move forward. First of all, it is in sync with the culture of the credit union movement. Now, NCUA is not part of the credit union movement, but it is easier to implement rules that align with an industry's culture. Credit unions were one of the original answers to the challenges of financial inclusion. We have to consider any decision to exclude individuals and groups from employment or service on the board of directors. Another reason I like this is it gives more people the opportunity to work in an industry where inclusion is at the core of it. This is good for individuals and credit unions. With today's labor market, few employers are immune to the challenges of finding good people. There's a massive array of potential workers out there who have paid their debt to society or whose offenses are relatively minor. This final rule cuts out lesser offenses and expands the exemptions. It gives greater flexibility for a credit union to hire an individual with certain covered records or allow them to serve on their board. The rule also delivers reg relief by reducing the instances where a credit union has to apply to us at NCUA to hire someone. At the same time, it reduces the resources required to investigate those applications that still need to come, when they still have to come to NCUA for approval. It is still incumbent upon credit union management. They are responsible for who they hire, and no one else is. But we put significant effort, went in by your team, to the public-facing side of this rule. Once approved, our website will be updated with forms and instructions related to the consent applications. This is intended to make it easier to find potential candidates to see if they qualify for employment under our updated rules, and relieves the credit union again from having to apply to us in a number of cases. I just have one question. Just run down on where we are with all this simplicity. How does somebody out there who now has a new set of rules and procedures for who they can hire and not hire, where are we on that?
Good morning. Thank you for the question. Appreciate the wardrobe compliments.
I don't even know if they match, by the way. I'm just saying. All right. Yeah.
Over the last few months, we've worked across the NCUA to ensure that the rollout of the final rule, if approved by the board, is effective, efficient, and transparent. In addition to the Office of Examination Insurance and the Office of General Counsel, we've collaborated with the Office of the Chief Information Officer, the Office of Continuity and Security Management, the Office of External Affairs and Communications, the regions, and ones. To prepare NCUA staff for the upcoming changes under the new rule, we've developed a consent application review chapter for our National Supervision Policy Manual. This content establishes a standard process for receiving, processing, responding to applications, and assigns roles and responsibilities across offices and job functions within our agency. In addition to drafting detailed guidance on completing each step of the application review process, we've created a regional summary template to guide regions and ones through the consent application review and develop template letters to ensure consistent communication with each applicant. The guidance and templates will aid in making our reviews efficient and consistent as we briefed regional management on key changes to the consent application review process in this finalized rule. I will now turn it over to Pam to discuss the updates to the application form and the development of our Fair Hiring and Banking Act landing page on the website.
Sure. Thanks, John. Yeah, I can give more details on, the website aspect. So the Fair Hiring Act does require the NCUA to make all form instructions related to consent applications available to the public, including on its website. So again, as John mentioned, in order to meet this mandate, we've been working diligently with internal staff development teams to create a dedicated landing page regarding Section 205D and fair hiring to ensure that the public has easy access to a variety of helpful resources regarding the prohibition and the consent application process. The website will provide links to the final rule, additional guidance, sample cover letters for both types of consent applications, and information about the process for the FBI criminal history record. And then because these consent applications do contain private and sensitive information about individuals, we are also working to develop and make sure that there's privacy protections in place. And the website will also provide links for more information for the individual on their privacy rights. We're also working on developing an online application form that will allow credit unions and individuals to submit their consent applications and supporting documents through a secure portal on the website. Again, because of those privacy considerations, we've been working with our technical teams to make sure that any sensitive information that is provided to us, through the website is properly protected and that it's properly handled throughout the whole application process. So we do expect the Fair Hiring landing page to be available soon on ncua.gov. And we'll be working on getting that done as soon as possible.
Thank you, Pamela. And just to review, we use the phrase consent application. Just to review, who is asking who for consent to what?
So the individual who has the covered offense can either submit an individual application on their own behalf, or a credit union that has a employee or someone that they would like to hire or a volunteer, they can sponsor an application and submit it on behalf of them. So it's consent from the NCUA board to allow the person with the covered offenses to work for the credit union.
And if you're an individual out there, you are not on the payroll of any credit union. Let's say you wanted to work at Roswell Community Credit Union. I want to work there, let's say, I have a record. Is this the sort of thing, kind of like having work visa in another country, where you go to them and say, hey, I'm already cleared to work for you in case you're worried about that? So this is something you do maybe when you want to apply or you're in the process of it?
Exactly. So just based on sort of the historical, applications that we've received, they do usually come from people who either want to sort of improve their prospects by already having it in hand because they know they have this background and they know that it may come up, so they would have it in advance. We've also received applications from individuals who are simply interested in working at a credit union, a federally insured credit union. They would like to join the industry. And so again, if they know that they have this background, again, they want to be prepared for that and go ahead and get consent so that they can apply
So you
to.
might be dealing with a hiring manager that says, ooh, this thing came up. I don't know if we're allowed to do that by NCUA. Now, that may be a cover for them not wanting to hire you anyway. That happens. But you can at least say, no, we've already got that stamp of approval on that. I am hireable if you wish. There is no regulations from NCUA that's going to stop this, right?
Yes, that's correct.
Yeah, no, it does remind me a lot of applying for jobs abroad, where you'd say, hey, I know you're a small employer, but I already have my papers, I have a work visa, you can hire me tomorrow. And it dramatically changed whether or not they'd be willing to talk to you. That will do it for my comments. Thank you, Pamela and John. Back to you, sir.
One thing if I could just ask that
Okay.
you alluded to it, and I think it's important. Pamela, I know when we brought the proposed rule up, I asked about fidelity bond coverage. Do we expect any real changes to the cost for fidelity bond coverage with the implementation of this rule?
Yeah, thanks for asking that. We did receive comments again this time from fidelity bond insurers and indicated that the rule should not have an impact on that. Of course, it does take, some time to kind of see an impact of a rule. Of
course.
But the comment was that they did not anticipate any changes. The insurers did raise that issue with the clarity of the wording in the regulation that the vice chairman raised. There was some concern on their part that it could be misread to imply that there might be some mandate on the insurer to provide fidelity bond coverage, simply by virtue of somebody having done the consent application process. When that is not the case, that it's a separate process. The rule was intended to just make clear that the fidelity bond requirements that are already in place for all employees under Part 713 also apply here.
Opportunities.
And so it was meant to be sort of a reminder of that, and it could have been misread, so that has been fixed in the final rule.
Great, thank you. Before I turn to a motion, Board Member Otska wanted to express her support for and weigh in on the Fair Hiring and Banking Final Rule. I'm going to quote her thoughts as follows. Quote, "The Fair Hiring and Banking Act expanded job opportunities in banking and financial institutions to certain justice-involved individuals. This law and subsequent rule highlight the positive impact that we can have when we make government work better for everyday people. This rule is a step towards leveling the playing field for working Americans trying to find a job as a credit union teller or as an administrative assistant, the essential but less glamorous jobs that keep our financial system running. Unfortunately, many otherwise qualified people who were previously convicted of minor offenses, like misdemeanors or petty crimes, were forever barred from working in any job at a bank or a credit union. The Fair Hiring and Banking Act and our implementing regulations remove some of the barriers for justice-impacted individuals to gain access to decent jobs and help financial institutions fill hiring gaps. I am proud to support it. Thank you." With that, Vice Chairman Hauptman, is there a motion?
Yes, sir. I move that the board approve final rule parts 701, 741, 746, 748, and 752 of NCUA's rules and regulations, rescind IRPS 19-1, and amend delegation of authority SUP 49 as attached to the board action memorandum.
I second the motion. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passes 2-0. With that, I have no closing comments. I don't believe you have any closing comments. I want to thank everybody for their very good work today, and that is the end of our agenda. There being no further business, we are hereby adjourned.